There we go. All right, welcome everybody to, I think, class number 6 of our fall financial series, compliments of the University of Arkansas, ASBTDC. My name is Scott. I'll be your host today, and thank you just so much for being here. This is a program of the University of Arkansas Small Business and Technology Development Center, also known as the ASBTDC. We're really happy that we can be able to do this for you. If you don't know about the Small Business Development Center, it's a one-stop shop for startups and existing small businesses. We're associated with the University of Arkansas and affiliated with statewide ASBTDC and the SBA other chapters as well. So there's a lot of chapters of the ASBTDC across the state, mostly affiliated with the major universities across Arkansas. And then across the nation, it's the same way. And there's about 1,000 different chapters across the nation. We were started as a federal program in the late 1970s in order to help small business owners and do economic development in local communities. Locally, we offer complimentary one-on-one consulting programs covering relevant topics for business owners. And if you're not already a client, we would love to have you join and encourage you to go to our website here at sbtdc.uark.edu. And then in the top right-hand corner, click register in order to schedule a consultation with us. All right, and see there on our screen is our website. And most of you have been to the website because that's how you registered for this. And there's our phone number and our email address as well. All right, again, my name's Scott. I'm an ASBTDC consultant in finance specifically. So a little bit about me. I've owned 2 of my own small businesses and I've got a background in corporate finance. Currently still have one business that I'll run with my wife. She's in it full-time. I'm in it a little bit less than part-time on the operations and finance side. It is a spa product wholesale business. So we sell spa products to spas is what we do. So all of the natural products that are sold at those kind of places, we have a partner manufacturer and they do the manufacturing and we help with some of the sourcing. But then we also do the retail selling and the marketing on that. And so that's my wife's full-time job. So we've been in business together for a little while and we're still married. So all is well, you can do it. So I've also worked in the corporate world, but my real specialty is finance, and I absolutely love teaching small business financial management to entrepreneurs. And I've been with the ASBTDC for right at about 1.5 years now, I think. And there's my email. If you want to get in touch with me personally, I'd be more than happy to sit down and meet with you, talk through any of these issues and just get you on the right track. I've got a lot of clients and would love to have you as a client as well. All right, so with that, let's just get into it. So the goal of the Fall Financial Series is this. It's to equip entrepreneurs and managers with the knowledge and tools required for successful small business financial management. And today, we're going to go over taxes as a part of achieving that goal. If you want to go back on our website, we've got 4 or 5 other videos from the series that you can go back and review as well. And in addition to the videos, we do a one-day, 4-hour financial boot camp that you're more than welcome to join. And that happens approximately once a month, maybe every 5 weeks or so. We're going to restart that in January. All right, so let's get going. So the first thing you need to know about business taxes is that a lot of the taxes that you pay are dependent upon your not just your legal organization, but also your tax classification. And so here I've just listed all of the different kinds of business legal organizations that you can have, as well as some different tax classifications that you can have. And I want you to understand, first of all, that there's a difference between the type of business legal organization that you choose and the type of tax classification that you choose. So on the left side, you've got your types of legal organizations, and on the right side, you've got your types of tax classifications. So some legal organizations that you can have for your business, you can be a sole proprietor, you can be a partnership, LLC, which is also known as which stands for a limited liability company or limited liability corporation, single member, and member just means owner. Or you can have a legal liability corporation, multi-member, or you can be a corporation. Most of you are probably going to be in one of those first 4 categories. The big difference between the sole proprietor, partnership, and LLC is that sole proprietorships and partnerships don't require any kind of legal filing or paperwork for you to establish them. But the drawback is that you don't have any legal protection of your personal assets if you happen to get sued for your business activities when you're starting off or ever. And that is why the LLC was legally created in our legal system. It's to protect the business owner's personal assets in the case of in case the business gets sued. So that's what that limited liability refers to, is that the owner has limited liability in case of a lawsuit. Their personal assets are not liable to claim of the lawsuit. Only the business assets are liable to that claim of the lawsuit. So that's the difference between the sole proprietorship, partnership, and LLC, and the LLC. So those are the organizations on the left side. I don't want to get too far into those. And then on the right side, there are three different main types of classifications that you're going to run across. The first is just called pass-through. The second is S Corp, and the last one is C Corp. Just very, very briefly touching the surface here on what these things mean and what they are. A pass-through entity means that it does mean that all of the expenses and all of the profits from the company pass through to the owner directly. Whereas an S Corp or a C Corp, those expenses and those profits are looked at as both, and so you wind up what we call a double taxation. So C Corp has double taxation. The corporation pays income tax, but then also the shareholders or the people that receive dividends, they also pay tax once they receive those dividends. The S Corp is kind of a hybrid of the pass-through and the C Corp in a way. Again, I'm just briefly glossing over this, not going into a super great amount of detail. But then pass-through, it's only the profits are only singly taxed because everything that comes through that company is paid for by the owners. And so before we move any further, I do want to say that I have to give a little bit of a legal disclaimer here. I'm not a CPA. I'm not legally authorized to give you tax advice. So all of this is simply me passing along information to you in order to do with what you want to do with it. So I'm not legally allowed to give you advice. This is not advice. You should always consult with your attorney and your accountant before you make any decisions based on this information. My goal today is to let you know that this information exists, to let you know where you can go research this information more in depth, and also to give you some of the tools and the vocabulary that you're going to need in order to be able to talk to your lawyer or your accountant and to give you an idea of what you may need to do. One of the things that we do a lot of here at the ASBTDC is provide this information to people. And if you do decide that you want to form an LLC, that is something I'm able to do for you. I'm not able to help you register a corporation. I'm not able to help you change your tax status from a pass-through to an S Corp, but I can help you file for your LLC. So as we move forward, I just want you to know that these different entities exist and they're all taxed a little bit differently and they all have different levels of liability. All right, so here's what I call the big four or the big five business taxes that you need to know about, that almost everybody's going to have to deal with no matter what state they live in or what county or what city they live in. Everybody's going to have to address these in some way in almost every single case, especially in Arkansas, which is where all of you are based. So the first one is the employment taxes. This is usually also matched by the employer. I'm going to go over each one of these in depth on the following slides. This is just the summary slide of all five. The next one is income taxes. We've already talked a little bit about it, pass-through versus corporate. And the third one is sales tax and excise tax, which is a very similar tax. Just, taxes come out on two different sides depending on, which one is classified as. The fourth one is property tax. And the fifth one is kind of like a tax, but it's actually insurance. And that's unemployment insurance and workers' compensation insurance. All right, so the first one, it's the employment taxes. It's the one that we all found out about when we were 15 or 16 years old. And when we got our first paycheck, we wondered why a third of it was missing and what the heck had happened. So it's the one that I wanted to start with because I knew it would be the one that almost all of us would be the most familiar with. So the employment taxes, if you're the employer, the employment taxes you are going to be matching for what your employee is going to pay every single month. And this is also known as the FICA tax. The FICA tax was established by the Federal Insurance Contributions Act. And that's where that acronym FICA comes from, FICA, Federal Insurance Contributions Act. And the employee and the employer both pay 6.2% to Social Security and then 1.45% to Medicare. So Social Security is that big fund that we all pay into the federal government so that when we retire one day, we hopefully that fund will still exist and we'll be able to get a portion of our contributions into that insurance or that big fund back when we retire at 63 or 65 or 67, whenever you choose to retire. The other part is that 1.45% that goes to Medicare, which is a government healthcare program. And again, both the employee and the employer pay this, but it's the employer's responsibility to forward this on to the federal government. So you will, as the employer, withhold 6.2 plus 1.45% of your employee's paycheck from the amount that you're paying them, and you will forward that to the federal government, but you will also be required to match that 6.2 plus 1.45 and forward that portion to the federal government as well. So in total, you will be sending to the government of that employee's paycheck 15.3%, but they're only paying half of the 15.3 and you're paying the other half of the 15.3. In order to do this, you report IRS form 941, and you must do this reporting and this filing quarterly. So for 2021, the first time that you would have done this, if you were open, would have been on April 30th. The second time would be on July 31st. The third time would be on October 31st. And the fourth time for 2021 would be on January 31st of 2022. So you will file in January for the previous year. So you've got to do it 4 times a year. All right, so the second tax I want to talk about is the difference between pass-through tax and corporate income tax, and getting back into a few slides ago, are different types of legal organizations and classifications. So the first two, sole proprietorship and partnership, both of those are going to be what we call pass-through classifications. So under both of those organizations, if you're a sole proprietor, that just means you've got a business yourself. You haven't filed as an LLC. You're the only business owner. You're the only person who operates it. And you're just all of that income is going to be considered part of your personal income. And because all of the income, all of the profit from that business that you're running as a sole proprietor will pass through to you as an individual. And that's how you'll get taxed, depending on your personal tax situation. Partnership is very similar. It's instead of it being your business being a sole proprietorship, it's run by multiple people who have an operating agreement together to be in partnership and business together. And again, depending on who owns what or what percentage of that business, which is going to be spelled out in your operating agreement that you have, that proportion of the expenses and the profit will be passed through to the individuals. So there's no legal entity that exists outside of you that is going to pay taxes on that business. All of the taxes and the expenses are passed through to you as the individual. An LLC by default is very similar. All of the profits and the expenses are passed through directly to the owner. But again, the difference between the LLC, the sole proprietor, and the partnership is the LLC is a legal entity that you file to register for, that you create. It has its own articles of organization, and it's a legal entity that provides the owner limited liability. Now, the LLC can change its tax designation. It's very important for you to understand. An LLC can change its tax designation from the default of being a pass-through, also known as a disregarded entity. If you look up on the IRS website, it can be changed from a disregarded entity or a pass-through entity to what's called an S-Corp entity. So it's still an LLC. The question is not, should I be an LLC or an S-Corp? The question is, should my LLC be pass-through or an S-Corp tax entity? And if you make it an S-Corp, it's taxed a little bit differently. So pass-through organizations can be LLCs, sole proprietorships, partnerships, and S-Corps are kind of a hybrid between pass-through and corporate. So then corporations are also tax classified as C-Corps, is their tax classification as a C-Corp. So let's talk about that a little bit more in depth. Okay, so what does it exactly mean to be classified as an S corporation for your tax designation? Essentially, what it means is that instead of you paying taxes on, if you're like, for instance, if you're a single member LLC, all the expenses and all the profits will get passed through to the individual, and they're all taxed, the same way. If you become an S corp, you can then pay yourself as an owner. You can also pay yourself as an employee if you're an S corp. If you're just a regular LLC, you either can't. I'm a little bit unclear because I'm not a CPA, but you either can't do that legally, or the way that the taxes work out, it doesn't really happen that way. If you file as an S corp, you can make yourself an employee and pay yourself as an employee, and then you still have to pay the employment taxes. The business will pay half of your employment taxes, and you'll pay the other half of your employment taxes, and you'll get a check every month from your business as an employee. But then, out of the net profits of your business, you can also pay yourself at what we call either an owner's draw, or what you may have also heard as a dividend. So you can pay yourself two ways if you file as an S corp. You can pay yourself a paycheck as an employee, and then you can also pay yourself an owner's draw. And those two payments are taxed differently. Your paycheck as a salaried or hourly employee is taxed through your employment taxes. So you're going to pay that half of the 15.3% employment taxes, but then you're also going to pay individual income tax on the money that you're paid for your business every year. And then you're also going to pay capital gains tax on any gains that you realize on the dividend that you receive from your business or your owner's draw. It's either capital gains. Again, I'm not a CPA, so I'm a little confused how it works. I think it actually would only be capital gains if you sell the business. I'm sorry about that. You will pay just individual income tax on whatever you receive in dividends from the business because it's regular income. But what you won't pay on those dividends on that owner draw is you won't pay that employment tax, because that is not coming to you as an employee, it's coming to you as an owner. So there could be a potential tax advantage for you there. The catch to that is that if you do file as an S corp and you want to pay yourself as an employee, the IRS does require you to pay what they would consider, or what they call, what the legal language is a reasonably comparable salary to a person who you would have to hire if you weren't doing your job. So if you're going to pay yourself as an employee, whatever position you're paying yourself as, in order to take advantage of the S corp tax classification, you would have to pay yourself the similar salary to somebody else who you hired to take your same job. So you can't pay yourself an unreasonably low salary in order to avoid taxes. And that's what some people try to do, and that's how they get in trouble. They say, well, I'm going to file as an S corp. I'm going to make myself an employee, but I'm only going to pay myself $1 a month. And then I'm not going to have to pay employment taxes. I'm only going to have to pay taxes on my owner draws. And so I'll be able to avoid a bunch of taxes. And the IRS said, not so fast. You've got to actually pay yourself what we consider a reasonably comparable salary for your position if you hired somebody to take that position over. Okay, that was all a mouthful, I know. I would love to talk to you about that individually, and we can work through that together, or go ahead and just go talk to your accountant. So the second tax designation is C Corp. That's what most corporations pay. And this is also known as double taxation, because the corporation is going to pay taxes on its profits every year, but then the shareholders of that business are also going to pay taxes on whatever dividends they receive. We currently don't have any clients who file as corporations, so I'm not going to spend any more time there. Most of you are going to be LLCs, sole proprietors, or partnerships. And you're probably, if you do grow and get to a certain size, it may be time for you to look at filing as an S corp. But if you're small and just starting out, filing as an S corp probably won't quite be ready for that. All right, so the pass-through and the corporate income taxes are both due depending on the type that you are, on either March or April 15th of every year. A lot of business owners get confused in their first couple of years of business because we're all used to paying our personal income taxes by April 15th of every year. But when you do go into business, specifically if you're a partnership and some other types, if you go into business, your tax deadline is actually March instead of April 15th. And I also wanted to make sure that you knew about, again, these FICA taxes that are due quarterly, and also know that if you're self-employed and you're paying any kind of self-employment taxes, there are times where you need to be paying what are called quarterly estimated income taxes as well. So don't forget about that, but that's more of an individual thing. All right, next, sales and excise tax. So these are similar tax, they're just taken out or they're charged at two different points in time in the product or the business life cycle. So the sales tax is charged at the time of purchase, and excise tax is charged at the time of manufacture, for instance, like gas. So a sales tax, that's charged like, you're at the cash register, you've got to charge the customers that are purchasing your goods sales tax. If you're excise tax, it's charged at the time of manufacture. That's the only difference. Most of you are probably in a retail type business. You're going to be paying sales tax at the time of purchase as opposed to excise tax. If you want to talk about excise tax, if you are a manufacturer and you want to see if you're subject to those excise taxes, shoot me an email and we'll get in touch and we can go over that together and figure that out. Not every company is going to pay sales tax. Generally, sales tax is reserved for people who are only selling physical goods. If you're selling a service, there's a good chance that you're not going to be required to pay sales tax. So for instance, if you happen to be like a psychologist or a counselor and you're just providing counseling services to somebody, or if you're a business consultant and you're charging for those services, you're not going to be subject to sales tax. But if you're a restaurant, or if you're a toy retailer or a t-shirt retailer, somebody like that, grocery, and you're selling physical goods, you will be subject to sales tax. If you want to find out if your business is subject to paying sales tax, I'm going to show you where to go. So this is the Arkansas Department of Finance Administration, or dfa.arkansas.gov, and you want to go to their Sales and Use Tax Division. And you can scroll down and you can see they're located in Little Rock, and there's their address, and they've got a phone number and an email. And I've called them several times and they're actually pretty responsive. It's usually, 24 to 48 hours, they'll get back with you through email. And they are very responsive on the phone if you just want to give them a call. And they're typically very nice, very kind, and they'll walk you through the sales tax code. It's pretty long and a little bit difficult to understand, specifically for the food business, because there's certain things that are taxed, different ways, like things like alcohol and that sort of thing. And some of those are subject to local laws as well. But I'll just encourage you to get in touch with them. Or if you want to get on the phone with me and we can conference in together, I'm more than happy to do that with you as well. Or you can just send them a quick email, say, hey, this is my business, this is what I sell, these are the services I provide. Am I subject to sales tax? What do I need to do? And they'll let you know. They'll let you know. Sorry about that. All right. Let's go back to the presentation. There we go. All right, sales tax, depending on the size of the business, it's due monthly, quarterly, or annually. By far the majority are monthly and are all due by the 20th. If you're a new business and you're just starting out, if you're a new business and you're just starting out, this Arkansas Department of Finance Administration, they're going to they're going to want you to pay this monthly. However, as time goes on, depending on how busy you are, they may move you to quarterly or even annually. I had a really small business just kind of on the side a few years ago that we did really great our first year, and we did monthly. And then our second and third year, we became very seasonal, specifically just right around Christmas. January to, really February to October, we weren't paying any sales tax at all. But then like November to December, we're 90% of our sales. And after the second year of doing that, they changed our filing schedule to be annually as opposed to monthly, because monthly I was just clicking 0, 0, 0, 0, 0. And they're like, hey, we don't want you to have to do this every single month. We can just switch you to annually. And that's what they did. But most of you are going to be paying monthly, and it's going to be due by the 20th. The way that you pay that is you register at the Arkansas Taxpayer Access Point, known as ATAP, for a taxpayer paying number or registration number, and you'll just go on there and you'll pay that monthly. And I can show that, guys, to you now. So that is right here. So this was my ID and my password for my business that you got there, but it doesn't work anymore. But this is where you'll go. If you want to register a new business, you can just click register new business down here and you can sign up. And then once you sign up, you can log in. And then it's going to ask for the double authentication. I don't want to get in there right now. But then what you'll do is every single month you'll go in here and you will remit to the state online. You can also do it through paper if you want to, but online is a lot simpler, how much you owe. And the amount that you collect, is dependent upon where, so it's the second one, collected based on where the buyer takes possession. So if you're an online seller in Little Rock and you sell something to somebody in Fayetteville and you mail it to them in Fayetteville and they take possession of it in Fayetteville, you don't charge Little Rock sales tax. You charge sales tax in Fayetteville. So you'll charge there's 3 rates that you have to take into account for sales taxes. You've got to take into, for every sale within the state, the Arkansas sales tax rate, but then also the county tax rate for where the purchaser takes possession, as well as the local municipality tax rate if there is one. So if you sold something to somebody in Fayetteville, you pay Arkansas plus Washington County plus the municipality of Fayetteville. And then every single month you would have to go into the Arkansas taxpayer system and you would list out the amount that goes to the state, the amounts that goes to the county, and the amount that goes to the municipality. It is very labor intensive. It does take a lot of time, especially if you're a high volume business. And it especially gets into even more complexity when you start selling things out of state. If you want more information on this, about, if you need to pay tax in another state and, how to do it and more efficient ways to do it, there's a great resource called taxjar.com that I'm going to show you now. And this is the website, and they have they've got products to help you with this kind of thing. They also have a blog about, do you need to pay sales tax? So TaxJar, sales tax, just say Georgia. So they've got a site specifically on Georgia, and they answer all the questions. So do you need to collect sales tax in Georgia? Do you have a physical nexus in Georgia? And what a nexus is, it basically is 3 intersecting items, or sometimes just 2 intersecting items that would trigger the law in the state that would require you to have to pay sales tax in that state. So, 20 or 30 years ago, before Amazon.com existed, if you were selling to another state and let's say you didn't have a physical office there and you had no physical employees there, you might not have what we would call a sales tax nexus. So if you sold something to somebody in Georgia, you wouldn't be required to pay sales tax. Well, then the internet happened and Amazon came along, and now we have a lot of these new laws that are sort of referred to as Amazon laws, which refer to Amazon.com because Amazon's selling all over the country. And there was a long period of time in our country's history where Amazon wasn't paying much sales tax anywhere because some of these sales tax nexus laws didn't exist. And now these nexus laws do exist in a lot of places, not every single place, that require you to pay sales tax in states, even under certain circumstances, if you have a sales tax nexus there. So if you want to look more information up on your own about that, I would go to taxjar.com, have a look, or also just get in touch with me. And I'm more than happy to walk you through that and sort of interpret or translate or whatever you want to call it to help you sort of make sense and dig through some of this information. All right, let's go back to our presentation. Some services out there now will do that for you because they've realized it's very labor intensive. Shopify will do this for you. There are settings in Shopify where they will calculate and collect the correct amount of sales tax based upon the delivery address of the items that you're selling. And then they will also remit that sales tax to the correct states for you. If you don't have the ability to do this, or if you're not using Shopify, if you hire an accountant, usually this is one of the things, one of the services that their offices will provide you, is to file your sales taxes correctly every single month. Not all states require sales taxes, and the laws are constantly changing right now because of these new Amazon laws, because states are wanting to collect as much tax as they can. And again, in order to do that, you go to the Arkansas Taxpayer Access Point. All right, 2 more to go. Property tax. Sorry, that should have been labeled number 4, not 2. I missed that on this presentation. Property taxes, just like personal property tax, it's a tax on significant items that you own, like cars, property, buildings, even equipment and inventory. And you've got to assess those, or have those assessed, and turn in that paperwork sometime between January 1st and the last day that you can do it of May 31st every single year. And then that personal property tax is due October 15th, and it varies by your location. And then I accidentally deleted my last slide on unemployment and workers' compensation insurance. So let me go over those 2 for you real quick. So unemployment, so one is unemployment insurance, and that is insurance that you pay in the case that you have, that you have to lay somebody off without cause. Like if your business shrinks and you need to lay people off because you can't pay them anymore, and they need to go collect unemployment, then your unemployment insurance that you pay to the state of Arkansas every month will help pay for that. And you can go read more about that here at this website at the Arkansas Division of Workforce Services. And again, it is a tax, Arkansas State Unemployment Tax. And then you can go to their employer services section here to get more information about that. The one thing to note about this is that the rate is different depending on a lot of different factors. The main factor being how many people you're laying off on a regular basis. So this and how large you are. This current rate ranges between 0.1% up to 5%. The higher it goes, if you get a higher rate, it's usually because you've laid more people off. So if you're a large manufacturer and you're constantly laying people off, then obviously your risk is higher. So your unemployment insurance is going to have to be higher. So the state's going to charge you a higher rate for that insurance. So you pay closer to the 5% mark. If you're a real small business, you've never laid anybody off, that's going to be a little bit lower. But if you do lay people off, this rate will increase, and it's something important to know. All right. Workers' compensation insurance is the other one that is obtained privately, and it is required if you have 3 or more employees in the state of Arkansas. One more thing I want to show you: in order to file taxes every year for your business, you've got to have a federal tax ID number for your business, and that tax ID number is also known as an employer identification number, and you'll need that. And the way to get that is you just go to irs.gov, just go to this website. The way that I find it, I just go to IRS EIN. You can Google it and then go to the first non-ad that you find. And there it is. And then you can apply for an EIN online right there. All right, so that is everything. Let me go back to that first slide to show you all the taxes that you need to be aware of. So these are the big 5: employment taxes, income taxes, sales and excise tax, property tax, and then unemployment and workers' compensation insurance. All right, I'm going to go back over to our Q&A and see what questions you guys have. Okay, so first question, with pass-through, does that mean filing that on our personal tax return? So yes and no. So you will file a different form, but you will file that different form with your annual personal tax returns that you file. So yes. Is there an inventory tax? So you will only pay tax as the owner of the inventory, you will pay personal property tax on the inventory that you own. If you sell that inventory, then you will charge sales tax to the customer when they purchase that inventory from you. All right, next question. I have a small LLC and incur a lot of expenses to operate my business. Do you have any suggestion on how to manage those expenses? So that question is going to be more of just a general business management question. I'd be happy to talk with you on how to manage expenses. That's a really broad question. Best thing to do is email me to get in touch. The thing right off the top of my head that I would suggest to you to be able to manage those expenses would just be to make a budget, first of all, and then to plan ahead. And I can help you create a budget, and I can also help you plan ahead by generating what we call a statement or a cash flow projection worksheet. LLC next question. LLC multi-member would likely be S Corp or pass through, right? So yeah, this is a good question, one we get all the time. So an LLC multi-member, that is just the business classification. It's not a tax classification. What an LLC multi-member means is that it's a limited liability corporation with more than one owner. There are some cases where it is just a pass-through organization, tax classification. There are other instances where you can refile or to reclassify to have a tax classification of an S Corp. Usually an S Corp is filed when the owners want to pay themselves, I believe the threshold is generally around $10,000 of income through the owner draw, is what I believe that I've heard on a kind of a general rule of thumb basis, but check me on that. But if you're fairly large, if you're not a brand new startup, but if you're fairly large and you can afford, so this is what the trigger is. I just remember the trigger to become an S Corp is when you can afford to pay yourself a salary of a reasonable comparable amount to what you would pay somebody else to do your job. It's at that point in time, if you've got that multi-member and you want to reclassify as an S Corp, that you would then go ahead and file as an S Corp. But again, go to your accountant, talk to them about your specific tax situation, or get in touch with me and we can look over your business finances and see if that would be advantageous for you. So another question about, do you pay tax on the inventory? So you'll only pay tax on inventory if you've got it on hand when you file to assess your personal property tax. And the way that your personal property tax is assessed is usually on a general average of the inventory that you carry throughout the year. But it's a property tax that, yes, you will pay on your inventory, on your average inventory that you carry. All right, next question. Okay, yeah, so about the LLC multi-member S Corp, if you're a small startup and just got going, I would not worry about filing to change your tax status to an S corporation at the moment. Again, I'm not an accountant, I'm not a CPA, I'm not a lawyer, so I can't legally give you advice. However, general rule of thumb in the business world that I'm aware of, and in my experience, is that if you're a brand new small startup and you can't afford to pay yourself a full salary, then filing as an S Corp would be premature. Sorry about that. All right, when I sell retail online outside of the state of Arkansas, do I charge sales tax? Generally, yes. It depends on where the person that you're selling to, it depends on where they take possession. So there are some states, and I don't know right off the top of my head, there are some states where people purchase things that when they're delivered to them, those states don't charge sales tax. So you would not have to charge sales tax. You wouldn't have to collect sales tax in those states. However, most states now, because of those Amazon laws, they do require sellers to charge or to collect sales tax. So depending on what state that depending on the state, the county, and town that your customer takes possession of the goods will determine whether or not you will determine the sales tax rate. And then what determines if you collect sales tax from that location or based on that location depends upon if you have a sales tax nexus there and that state and local laws of the place where the customer takes possession. So it's all about where the customer takes possession. Okay, next question. As a sole proprietor, is it mandatory to pay estimated taxes quarterly, or can you pay at tax time? So this is something I'm a little unclear about, but it is my understanding that it is required every quarter as a sole proprietor. The only time that it wouldn't be required would be in the first year. So for instance, when I went into business for myself, I didn't pay it my first year, but then I filed my taxes and the IRS then said, okay, here's your new estimated quarterly taxes that you need to pay for your self-employment taxes, and you need to pay those quarterly. So I do believe it is quarterly as a sole proprietor, yes. Online sales outside of the state of Arkansas require more than Arkansas sales tax permit. Let me read that question again. So online sales outside the state of Arkansas require more than an Arkansas sales tax permit. Yeah, so you will have to register in each one of those states to be able to pay those sales taxes, unless you've got a service like Shopify that'll do it for you. Yes. It's a lot of work. I know, it's very inconvenient. And it's not necessarily a permit that you've got to pay for in every case. It's just a number that they need for your business so that they can know that you're filing. But yes, most states require you to collect sales tax for the things that you sell, and then for you to remit it back to that state, county, and municipality. And yeah, y'all, I know that this is it's not information that's really easy to put into like super simple categories, because there's so many different circumstances out there. There's different states with different laws, and then there's different tax classifications for all these types of businesses, and there's different circumstances for every kinds of business. And almost everybody that we deal with has a little bit different circumstance for whatever reason, plus they've got their own personal circumstances, and so it is a little bit complex. That's why we wanted to give this video for you guys, just to help make you aware of what's out there. And you can either research it yourself then, or you can get in touch with us, and so we can hear about your personal circumstances and we can walk you through it individually, or we can research your specific question and get back with you with an answer. So that's something that I do a lot of. If you have a specific question, you can get in touch with me, ask it, and I'll spend some time researching it for you and helping you walk through it. Yeah, a lot of people are saying that they didn't have any idea about having to remit sales tax, and yeah, unfortunately, it is true. States want their taxes as much as they can get them, so they're requiring sellers to collect sales tax even for out-of-state sales, and then they're requiring us to go to their websites and then remit those payments that we've collected. But again, it's not something you're charging; it's just something that you're collecting for the state, and then you're just remitting that back to the state. All right, it's 2:47. I've got time for definitely a few more questions. So the penalty depends on, the amount that you haven't paid, and it depends on the length of time that you haven't paid. Best thing to do is I would just get in touch with me, and we can do some research together to find out what that might be for you. The other state that you're selling to, they may not require you to collect it, and we would want to find that out first. But we definitely want to get you up and going. But every state, every county has a different penalty. And you do want to check. I do think that I had some photographer friends several years ago. They were doing photography services, and there were some of their services that they weren't having to pay sales tax on, but then when they were delivering some of their services were actually delivering physical goods, and so they were having to collect sales tax, and they didn't by mistake, and they didn't do it for like 4 or 5 years, and they had a pretty hefty back pay and penalty. So you do want to make sure and get in touch with the Arkansas Department of Finance and Administration Sales Tax Department. And I'll go back to their website real quick so you can see that contact information. You definitely want to get in touch with them. Yeah, here it is. Definitely want to get in touch with them to see if you need to be collecting sales tax depending upon your product or service. Yeah, so this webinar, by the way, was going to be posted at our website. Let me show it to you real quick. It's at asbtdc.uark.edu, and then just go to resources and click documents and resource library, and then click finance resources. And then you can scroll down, and this is where all of my videos are posted. Some of these are mine, some of these are other people's. We've got a lot of resources here. So it's finance and accounting. Let's see, where's one of my videos? Yeah, #1 resource, business close. That's mine, video posted right there. Let me turn off my notifications. I forgot to do that. Do not disturb for an hour. There we go. But everything will be posted right here, and it'll be posted usually within the next 24 to 48 hours. I started in September. So next question, I started in September of this year. I have to file monthly. Do I file 0 every month for my first year, even if I make $1? I started in September this year. I have to file monthly. Do I file 0 every month for my first year, even if I make $1? So for your first year on sales tax remittance, even if you don't sell anything, you still have to file the report. Even if you don't have anything to remit back to the state, you still have to fill out the report at ATAP. You still have to go here. You still have to click through the buttons, and you still have to tell them, you have to report to them, I didn't make anything at all, so I've got nothing to remit to you. Or I did make sales, but none of it was to anybody in Arkansas, so I still don't have anything to remit to you. But you've still got to do the report every single month, unfortunately. All right, next question. I know in-person events out of state require a permit for that state, but like you said, it's not an actual permit, and a third-party service takes care of it. Literally just got my sales tax permit days ago, but I don't have my website up yet. Yeah, it's definitely confusing. I'm happy to talk with you about that. And again, here's my contact information. So just sl072@uark.edu. Just shoot me an email and we can set up a time to talk together. All right. It's 2:52. I'll hang around for a few more minutes in case anybody has any other questions. I'll show you guys some of those other slides. So most of you, I would suggest, if you're wanting to start a new business or if you've got a new business, go ahead and register and file and create an LLC single member, unless you have more than one person, in which case you'd be a multi-member. If you do have a multi-member, you will need to put into writing who owns what. It's called an operating agreement. You can go on LegalZoom and get one, or you can just create one from scratch for free yourself. You just want to write down, who's contributing what, who owns what, and different circumstances for distributions and who controls what. All of those, questions that can be a little bit thorny and difficult to talk about at times, but you just want to get that lined out in the beginning. And then most of you are just going to be what's called a disregarded entity, also known as a pass-through entity. So disregarded entity or pass-through entity. And that's the default classification for LLCs. And these are the big 5 that you're going to be paying. I guess you could call it big 7, technically, but the big 5 that all businesses will be looking to pay. And again, then there's the FICA. All right, y'all. Well, thank you for coming. Thanks for being here. If y'all don't have any more questions, one more question. Let me make sure I get everybody's attendance here for the reporting. I think I got everybody. All right. That's it for today, y'all. Thank you so much. And be on the lookout for our next webinar. I believe it's in a couple of weeks. We're going to cover how to sort of cover all your bases and put your best package together in order to get ready for investments or loans in order to start or grow your business.